main point to note, really, I suppose, is that we have broken out through a major resistance line here that goes back all the way to 1980. And these big breakouts, when they happen in these gold bull eras that developed during the 1970s and the early 2000s, were kicked off by this recessionary period shown by the green bars. So clearly we've had a major breakout here, and clearly there are a number of technical pieces of evidence why a recession is pretty likely during the next, let's say, few months.
Hey guys, welcome to Capital Cosm. Today is a special episode where we have three of my favorite TA analysts. I guess that's redundant, TA analysts. TA chartists, Kevin Wadsworth and Patrick Kareem of North Star Bad Charts, Finding Values, Andy. Anyways, no. Hey guys, thank you so much for coming on.
Thanks, it's great to be here.
All right, well, let's just dive right in, fellas. Markets are closed today. It is President's Day. So what better time to look at the charts when they're not moving? Let's kick things off here with you, Andy. What are you seeing out there? What is the top of the line news item, or what is most topical for you, let's say?
Well, I mean, when I go out there and I look, gold's been ripping. It's going on up. That's our leader for commodity bull market. So gold's been making new highs. It's breaking downtrends against other asset classes. So I think the commodity bull market's just starting. It's alive and well, and gold's our leader, and it's leading. Other things or other sectors that I think look notable. Copper looks like it's trying to break out. It looks like platinum's trying to break out. A lot of commodity sectors looking like they're squeezing up and trying to break resistance lines and trend lines. So I think everything's intact. I think everything looks good. The overall S&P 500 and NASDAQ, they seem to continue to drift higher. At some point, I'm looking for them to roll over, and it just hasn't happened yet. So that's kind of where I'm at, what I'm looking at. So silver looks good too. That's ready to rip and break out. So I think everything looks good. I think it's more of just sitting there, being patient, waiting for these things to all kind of break out and materialize in front of our face here. So I think a lot of stuff looks really good.
Any key charts you want to look at before we start digging into the nitty gritty? Because I have something I want to show you if you don't.
Well, go for it first. You can always come back and grab something.
Yeah, so this is the NASDAQ divided by the M2 money supply. And obviously what you'll notice is we just hit the same high that we did in 2000. What do you make of that? Have we, because just kind of put a little color on it for people watching. Then
it just means
M2
that
money supply is a total amount of money sloshing around into the system. Obviously, there's way more money today than there was in 2000. So this kind of controls for the flow of money into the system. When you control for the money supply relative to the NASDAQ, you'll notice that the NASDAQ is valuated at just about the same level that it was back in 2000.
Yeah, so my opinion on all this is that it's just telling us where money has flown into. So money has flown into the NASDAQ. That's where it currently resides. And that more than likely the NASDAQ is overvalued in relationship to the M2 money supply given history. So the way that I view it on like a big picture view, I think that money is all pushed over into financial assets. Originally, it went to bonds and stocks. We had a 40-year downtrend in interest rates that ended in the total bottom was 2020 and started to break and move higher. The bond market sold off in 2021 and forward. It broke its uptrend to the downside. Money started to rotate out of the bond market. It went into still stocks and financial assets, still like the NASDAQ and S&P. It started to work its way into commodities a little bit. So when I look at all this and we look at all the ratios and all the metrics, I think because of interest rates and the 40-year decline, it all got jammed into financial assets. The bond market was the first to basically sell off. Interest rates are going on up. Interest rates at some point will have an impact on the stock market. It may not be immediately, but usually when it goes above about 5%, that's when the stock market really starts to feel it. And eventually, I think the stock market, like the NASDAQ and S&P 500, will roll over. And gold does real well during that rollover. So you'll see gold start to break out against these other asset classes. And then when you see that ratio start to break out, like gold breaking out against the S&P 500, gold breaking out against the NASDAQ, that's usually the beginning of the commodity bull market. And money starts to flow out of stocks and out of bonds. Interest rates will continue to creep higher, and money will start to move into precious metals and other commodity sectors. So that's like oil, copper, platinum, all those different areas. And that's exactly what we're seeing in all the charts. We're seeing these big squeezes into the corners, the big squeezes of or horizontal breakouts of copper trying to break out. We're like right at the beginning of all of this money rotation, but it's going to be very frustrating for a lot of people because you get in the beginning of these big bull markets, you get lots of volatility and a lot of sideways chop. People get frustrated with it. You're trying to break through like a billion different trend lines, so you get stuck all the time trying to break out of all these bottoming patterns. So people get frustrated and they give up. And I think that's the wrong approach or attitude. Commodities, when you price it against anything else, it's dirt cheap. We're coming off the bottom, and all of the quote market conditions that I look at, like interest rates and stuff, are all improving in a positive way for this to eventually play out over the next, say, decade. The only tough part that I would say that I have in the short term is, are we going to get a recession or a big pullback or something like that in the short term, which is a tough read. A lot of this was being held up by fiscal spending. So they're pumping money into the system. Fiscal government spending is what fiscal spending is. So government spending. And then we've got Elon Musk and Trump that just came in and they're like, we're going to cut all this spending. And I'm like, oh, is this the beginning of a potential slowdown or recession through unemployment, through governments and less spending? It could be. That's the only difficult part, is the path between where we are today and this commodity bull market. Is there going to be a pullback in interest rates? Because usually you break the big downtrend, and then you get a pullback in interest rates, and then we go from there. So it's just, what does that look like? Is the pullback in inflationary, like it's a stagflation type movement, or is it more of a pullback recession and things sell off? That's the only thing that I think is a difficult read here in the short term.
Right.
But longer term, yeah, everything's intact. Everything looks good.
Right. Kevin, what are you seeing out there? What is front and center for you? And if you have a response to any of Andy's comments, go for it. And feel free to share any charts you'd like as well.
Yeah, sure. Okay. Well, a picture does paint 1,000 words, so I will share a couple of charts here. Let me just share my screen with you. Give me a moment to make sure I'm sharing the right screen. Okay, just bear with me a moment.
Patrick, give us a joke or something.
Well, yes. Well, look, everything that Andy he said there, it's good. I could add some stuff. Like, part of some evidence we've gathered is we have this concept called the CRE, capital rotation event, but Andy was expressing it, but just in a different way. But we've like tried to like brand it, so it like really focus on these events where, like, the 1970s, where gold breaks out in a new uptrend versus SPX. Gold breaks out in 2000 versus SPX, right? And the same thing, we're waiting for that again. You mentioned the NASDAQ, but SPX, same thing. There's always, although like doesn't mean it has to be, but there's always been a recession exactly on the candle, on the monthly candle that gold breaks out, or practically on these CRE events. It's like you almost need that depression. You need that fear, or you need the markets to anticipate that crazy amount of money printing that's going to be required to save the U.S. equities. You kind of need that recession to Kevin's going to show you, to kick that stuff off. and every single recession has the SPX drop, every single one. So you cannot have a capital rotation event without having the stock markets drop. Like even gold outperforming, let's say SPX on the way up. I don't trust it as much. I want to see rollover. So once I get that rollover, like a 5, 10, 15% rollover, but the market thinks the rollover is going to be even more than that. Like the market's going to start pricing, hold on, this is not a random 15% correction for the SPX that we're going down for the count for longer. For me, once the market realizes that, that's it. That's the point of recognition. That's a capital rotation event. And that's when you buy the dips. Copper is probably going to break out, or copper could even break out before. And if there's that recession, then it's going to come and retest that horizontal breakout line because copper has a great chart. So it's again, how are these locksteps levers? Are we going to get a breakout, but then a retest and then off it shoots? But for me to have this true long-term bull run in oil, this true long-term bull run in silver, and even gold, even if gold's done great, it's in a bull market, for it to have a crazy bull era, I'm angling right now. We need a SPX drop. We need a recession. And that's gonna crystallize that capital rotation event.
Yeah. So whilst Pat's been talking about that, I just got the gold chart on here, and the main point to note, really, I suppose, is that we have broken out through a major resistance line here that goes back all the way to 1980, and these big breakouts when they happen in these gold bull eras that developed during the 1970s and the early 2000s were kicked off by this recessionary period shown by the green bars. So clearly we've had a major breakout here, and clearly there are a number of technical pieces of evidence why a recession is pretty likely during the next, let's say, few months. And not least of that is not the least of those reasons is the yield curve inversion. This is the yield curve inversion chart which we've looked at before, and it's the 10-year yield minus the 2-year yield. And each time the yield curve becomes uninverted once more, you get a major market event of some kind. And it could be the early 90s recession with the recession shown there by the green column. It could be the Asian crisis, the dot-com bust, again, another recession. GFC subprime recession occurred a few months after the yield curve uninverted. The repo liquidity crisis, and that brings us to where we are now. We have uninverted. We are really staring down the barrel of a named event and a recession of some type. Now, this all ties in with the high likelihood of a high impact event. So that's a high likelihood of a high impact market moving event. And that is also backed up by the capital rotation evidence, whereby gold has put money supply into a bear market, DXY into a bear market, CPI, PPI, currency in circulation, the equal weighted S&P, the New York Composite Index, the Dow Jones, the Wilshire and the Russell are all in bear markets versus gold. Okay, and I'll just pick one of those. This is the Dow Jones versus gold. And you can see it's given 4 signals in the last 100 years. The first one was in 1930, breakdown. Dow Jones fell something like 85% or more, actually, versus gold, and the S&P fell 85%. And it took 24 years for the S&P to recover, during which time gold had to be repegged 70% higher, even though it was a fixed exchange rate between gold and the US dollar. It had to be repegged 70% higher because of the forces of the capital rotation event there. The second capital rotation signal in favor of gold came in the period 1968 to 1972, when again the chart broke down. The Dow Jones broke down versus gold, and it fell more than 50%. In fact, the SPX fell 50% and took a decade to get back to where it started. Gold rose 2,400%. The same thing happened in the early 2000s. The S&P fell 50% twice in this period, and it took 13 years to get back to where it started, during which time gold doubled, and then it doubled again, and then it doubled again. So I showed you this chart last time we spoke, and it was just starting to approach the critical support level. Well, guys, it has now broken below critical support. the roadmap continues, and we are one step closer to a major market event. Something I want to point out, just whilst it's on my mind, is that silver gets mentioned a lot. And you're asking Andy there, major sort of comments he had, what he saw as being particularly good at the moment. And I would have to say silver is not the time for silver yet. And it probably won't be for at least another year. And I'll explain why. It's because silver, and I'll just pop up the silver chart for you if I can get it on the screen here. Silver is meandering its way very slowly from sort of, I don't know, $15 to 20 to 25 to 30 to 35 to it's heading to $50, but it's not doing it in a very exciting way. It has a little move to the upside, then it goes sideways for months. Everybody gets frustrated, then it has another little move and goes sideways for months. It's meandering its way towards $50. $50 is not the target. It's the initial target, but it's not the target. All of this is one massive cup and handle pattern that has been forming since the 1970s. And what we're going to have, in my view, is this cup and handle is going to be down here in the bottom left-hand corner of the chart. And when silver really has its time to shine, it's going to do something like this. Okay, so whether it moves to $150, $200, or whatever number it goes to, that is not going to happen until we have the recovery, because silver is a recovery metal. Silver does not outperform gold before the stock market has fallen 50%. So this capital rotation event that we're talking about, this period in time where all of these things roll over versus gold, and in particular the S&P and the NASDAQ, once they have fallen 50% in nominal terms, and the NASDAQ probably more than that, then it's during that recovery phase, and bear in mind the drop for the stock market probably takes a year to 2 years. So, and it hasn't even started yet. The stock market hasn't even started to fall yet. And that's a critical part of the capital rotation process. It's got to drop for a year or two. And then after that is when silver is highly likely to outperform gold.
Can I share my screen because I have the visuals for exactly what you just said there?
Yes, I think you do that part. You do that.
I'll just share screen. Oh goodness, it is complicated, the sharing screen. I don't know what to do. Share screen.
Go to present at the very bottom. Andy, do you have any thoughts on what Kevin just shared? Oh, there it is. Okay.
There.
I'll get to you in a second, Andy.
Yeah, it won't be long. This guy's on the top is the gold to silver ratio, right? Everybody's always looking for, you have gold. The gold silver ratio tells you, I'm a stacker. I want to either hold gold or silver at all times. Which one should I hold? So if this thing is going down, you want to hold silver because silver is outperforming gold. If that thing's going up, you want to hold gold instead of silver. Now look at this. Every time the gold silver ratio goes down, so that's the time to hold silver instead of gold. These crazy meaningful runs where silver outperforms drastically gold, they happen on the instigation of a huge market drawdown. So here's the market's going down 58%. As soon as the market bottoms and the aggregate of market participants realize this is the bottom, of course, in hindsight, we'll know this, but as soon as it starts breaking out, look what happens to gold silver ratio. It goes down. Here again, the markets in the early 70s, they go down 47%. When they bottom and they start moving up, look at the gold silver ratio. Bam! That's when you had that crazy run, right? Same thing again. Markets go down. After that, at the exact bottom of a huge 27% drawdown on the monthly close basis for SPX, gold to SPX ratio, gold silver ratio does the same thing. The 2000s, right? Not the 90s here. The 2000s, the market look exactly practically at the bottom in 2003 when it started going back up. That's when silver outperforms gold. This is what Kevin's been saying. Look at here, 2008. It's when the market bottoms. That's when silver goes bonkers, right? It doesn't mean silver can't go bonkers nominally. It could go up, like Kevin said, there it could go up, to $50. But the true end game melt up crazy mode is after the markets break down, after we had the recession. And once they bottom, like Kevin said, it's a recovery metal. That's when you go along silver. It's early now. Yes, you could make money. Yes, it has some higher up targets. That's fine. But the true crazy moves, they're not here yet, guys.
And it's exactly the same thing with platinum. If you look, I said this last time we spoke, Danny. Gold is in a bull market. verging on a bull era. Bull era comes after the capital rotation event has been confirmed. That puts gold in a multi-year bull market versus stock markets. That's a gold bull era. Okay, so we know that that's the case. So stop pricing things in dollars, right? Forget about your dollar related charts. Forget about looking at, StockX or stock wine dollars, gold miner, silver miner, platinum. Okay, I've heard a lot of people talking about platinum. Don't price it in dollars, because just because platinum's going up doesn't mean you should be positioned in platinum. If platinum priced in gold is going up, great. If it's broken out, buy your platinum. But if platinum has not broken out versus gold above major resistance, what are you doing? Stay in gold, because gold is the winner. So we know gold is going to win for the next 10 years. Get this in your brains. Gold is going to win for the next 10 years. If you do nothing but put your hard-earned savings in gold, if you've done nothing except put it in gold when it broke out above $2,000 and just leave it for a decade, you know that it's going to double again, and then it'll probably double again. And for most people, that is brilliant. You're smashing inflation, you're watching your capital growing, and you're having to do nothing in the meantime except just sit back, relax, and watch it grow. That's what happens in a gold bull era, and we have the evidence for that. So do not then start getting distracted with platinum, palladium, lumber, lithium, uranium, whatever the hell is people are talking about on social media, unless it's broken out versus gold. Broken out versus gold, great. Put some of your capital into to work in that. My strategy, my suggestion would be keep the bulk of your savings, whatever you want to call it, your NAV, park it in gold. Don't park it in dollars, park it in gold, because we're in a gold bull market. Then from that, maybe have, 20, 30% to play around with trading, whatever percentage. It might only be 10%. It depends on your personality. And if you want to trade stuff that isn't a bull market versus gold, nothing else.
Yeah, perfect analysis, segue actually into our sponsors for this episode, which is ITM Trading. For all of your gold stacking needs, check out my partners over there who will set up a strategy call, free at cost and no obligations or commitment necessary. Check them out. Prices are really great. The people are great too. Top analysis and experts on the call with you at all time. I have the link to that down below, as well as the phone number for all of you guys that are interested. Andy, any response to what either Patrick or Kevin have kind of spoken about so far regarding silver? Do you share the same viewpoint that silver is silver's time comes after certain capital rotation event, after the market kind of bottoms out?
Well, yeah. So what I think drives a lot of the movements of the majority of this stuff is currency exchange rates and the value of the dollar. So if the dollar drops, that's where a lot of these will take off. And then your currency exchange rates against the dollar will cause capital to rotate out of dollar denominated assets. So you'll see emerging markets and stuff like that also go up as commodities go up, because commodities are priced in dollars. So gold is the leader of it generally. Gold is like a real-time accounting mechanism of, we'll call it liquidity or inflation. So gold usually runs first, and then the rest follow as that liquidity works its way through the system. So what we saw in 2020, almost real time, when they printed money and came out with that stimulus, gold took off very quickly in that March, April timeframe. It just shot right up. And then about, with some time delay behind it, then you saw oil and silver and some other stuff kind of go behind it, platinum. So what I think is occurring is the market condition, which could be a slowdown. That's where gold gets its safe haven asset, name. It's these yield curve uninverting and stuff like that. Gold generally front runs liquidity to some extent, because there could be an event coming, and gold would be a signaling that. But let's just take another approach and a different strategy is what I'll talk about right here. So let's just say that I don't try to time or predict the market at all. Let's just say we take the good old approach of Warren Buffett or some of these guys. So Warren Buffett and a lot of these guys like Peter Lynch, where they try to find value, they try to find a discrepancy between price and value. And ratio charts, for the most part, is that discrepancy between price and value compared to history, taking, for the most part, the dollar out of it, the dollar pricing. So if you could take like a silver or platinum or oil or whatever right now and price it against gold. Gold is moving, that's correct, and it is the better play in the short term here for sure. But from a valuation perspective against gold, oil, silver, and platinum would be better investments for the long term if those ratios were to revert to the mean. You have a larger margin of safety because gold is now well above its cost curve. Platinum is below it. So if you were to take a longer kind of approach to the markets, you could say, well, platinum is historically an anomaly compared to history on the ratio front against all the other metals almost. And you've got the largest margin of safety from a ratio perspective and also from a cost curve perspective because the largest mining companies in the world can't make money at the price that it is currently at. So from a statistical probability of success, you're going to win because they're going to have to cut production. So you're buying it at the least risk area, irrespective of what maybe a chart will tell you. I'm just talking about kind of the fundamentals behind it. And it's very well true that it hasn't broken out of its chart yet, and it hasn't moved. So oil's the same case. And I'm not stating that oil can't go lower or platinum can't go lower. What I'm stating is just from a risk reward perspective and what the companies can do, the higher cost producers in oil, they can't make money at $70 a barrel. So what you're seeing is you'll see energy service companies, you'll see offshore and rigs get pulled, which is happening right now. And the ratio against gold is 40-1, so 40 barrels of oil to 1 ounce of gold. So the question then becomes, if you can play oil, and it becomes a waiting game and a patience game, because the price of oil with time has to go higher. It can go lower in the short term. It doesn't mean it can't go lower, but it has to go above 70 to produce more supply, is what I'll say. And if demand continues to go up and inventories continue to get depleted like they are, then it becomes a waiting game and a patience game. So I'm not stating that that you can necessarily, if you take a strategy where you take prediction or potential outcomes like out of it, like let's say you don't know the future at all, and then you say, well, how could you play that game without using any sort of predictive function? You would play it with value discrepancies, and those are the spots that have the value discrepancies is how I would respond. But that doesn't mean that it will outperform it in the short term. So there's a market component to it, and gold's obviously broken out. It looks fantastic. I totally agree. I think it's the leading indicator of what's to come behind it. And I would position in the stuff that would be the cheapest and most potential upside that I think has a high probability of occurring. So that's kind of my approach. It doesn't mean, and there could be things that are unforeseen in the future. So for instance, I'll just tell the unforeseen things. So I purchased silver from 2018, 2020 when the ratios were really cheap. I purchased platinum when it was really cheap. 2020, 2019, 2021, when it was below a certain price, I kept kind of cost averaging in. I don't know what the future looks like necessarily, but there could be things that change dramatically out in the future. So it's a function of diversification to get out of the system is number one. And number two, I don't know if the premiums will stay the same. I don't know if, when an event could occur where people run at this stuff. It's a function of like preserving and protecting wealth. And I do it across gold, silver, platinum, and all these different metals. So I'm diversifying across, and I take into consideration the valuation of the metals that I'm getting it at, and if it's below the cost curve. So I'm buying all these metals below the cost curves, and I'm just sitting in them and waiting and being out of the system to protect myself and diversify myself against the system. So that's kind of my strategy and approach. I know it's not going to, I know that platinum may or may not rip immediately, but it doesn't matter, because when it starts to move, I don't know what that world necessarily looks like. We're seeing in the markets with gold right now that they're having problems delivering it on major exchanges like the LBMA. And all it takes is, our people to kind of panic. And then it's like you had physical metal available to you very easily. And then in the future, it's like, is that still going to be there at the same premium? What's going to happen? There's so many unknowns. I don't know. So what I do is I say, is it cheap? Yes. Is it cheap historically on the ratios? Yes. And then is the premiums cheap? Yes. And then I just buy it and then I hold it. And then in trading accounts, I have other stuff that you may trade or whatever. I don't really trade too much, to be honest. I just find value discrepancies and invest based off the value discrepancies. That's really my main goal and my main focus. And that's how I've made a lot of the money. Like for instance, in 2020, the bottom there, we had that huge crash. There's a lot of fear in the market, and all of your value discrepancies from a ratio perspective, like just peaked out, like total anomalies in history. Oil went negative. It's like, what the heck? So I waited for it to come back up and pause, and then I bought a bunch there. They obviously printed money, which was the stimulus money, but the value discrepancy was there, and you can do a bunch of fundamental analysis on stuff too. So the technicals look good, the fundamentals look good. It kind of all aligned in that time frame. So I'm trying to find that alignment, but I'm overweighting the value out of it, the ratio discrepancies. There's also other things too when you look at like really long-term big picture charts. Like platinum is just, it's never been this cheap against anything. Now someone could say there's a reason for it. There's obviously reasons that somebody can make up a narrative or whatever. But what I'll say is the market conditions determines that ratio. When gold outperforms platinum, stocks generally go up. And then when that reverses, stocks generally underperform. It was a study done by people at Yale. I can't remember their names. But when the platinum to gold ratio outperforms, which I do think is coming, the stock market will underperform. And that generally occurs during certain market conditions. Are we transitioning from that one market condition to another? I think we are in the future. We're just not there yet. So it's coming though. So that's where I'll kind of end it. Hopefully that answered most of the question.
Yeah, Patrick, anything else you want to add? Otherwise, we can move on to energy here in a second.
No, let's go to energy, man. That's an interesting chart there.
Yeah. So, what's your view on the current price action of oil?
All right, let's do it. I'll share my screen. Share it. I'll do it live. Yeah, we're looking at Smith & Wesson, right? Look at that thing. Anyways, all right, let's look at oil, guys. Let's look at oil. So this is the maximize. All right, here is the oil chart. All right. So this chart, guys, look, it's this line here, a monthly close below $68, 68, 67, like a solid close here. Not good, right? But right now it's not good on the upside either. It's like, it even tried to break out here. So here you have a resistance area here, and you have a support. So it's coiling, and there's no, look, that could be a topping pattern. It could be a continuation pattern where you have to wait until the market tells you what's going to happen. So a bullish case would be go up here, maybe retest that 3-year moving average, 36 month. And then after that, zoom up, right? Because there's so much damage done because it went down, guys. Lower highs. It's creating a whole bunch of resistance here. So for it to get out of its rut, and break out to the upside, we could be in 2020 in June, 6 months later, 7 months later. It's crazy. I said 2025 like it's next year. We're already in 2025.
Patrick,
It's a
what
couple
do you
months
make?
away.
What do you make of the commodity index appearing to rip higher while oil is doing the opposite?
Which one, the CRB, because or the CR?
Yes, let's do the Thomson Reuters one.
Yeah, because you have to look at the CRB, no CBR. What is it? What, no.
It's TRJ, EF, CRB.
I got it. All right, this one, new price scale. Yeah. Well, what's the composition of that thing? You have to look at the. Yeah, you would have to look at the composition of it, right?
It's one of the better ones where it's not oil heavy.
That's right. Well, it probably explains why it's starting to move up there.
Mm-hmm.
Yeah, that's pretty good though, actually.
So what's going on there? Why are commodity prices appearing to rise while the oil price is going down? That seems like it's an exception.
Well, hold on. Well, what's oil telling you there? If it's not ripping higher, is it telling you that it's sensing a recession? Is it telling you that look at the recessions? Look what happens to oil here before the crash. Look at that. Before the recession, look, oil was already showing lower highs, kind of where we have today, and then it fell off a cliff before the whole thing imploded, right? So that's what happens here. It went up during the recession, but after that here, it went crashing down. Up here, it trying to go up, but then after that, it fell, and that's the 2000 recession.
9/11.
Yes, 9/11 right here. So that's the CRE, right? That's when gold broke out versus SPX. That's when SPX topped. This is a major event right here. So what's happening here? It's like the yield curve uninverting. It's all these observations Ken and I or Andy are saying, they add up, guys. And it's our job. We do it regularly. It's like there's something happening here. There's not look, the CRB could be going up, but if oil tanks here, what could be happening to the CRB is it could just be and retest and then shoot up, right? It's just going to reshoot up from a higher price point, right? It could do that. That could be pretty impressive if oil decides to. I'm going to remove that one.
Yeah, my point is that for a very long time, the CRB tended to be correlated with the oil price.
Well, they are. But if I zoom out, yes. But what you got to look is, I'm going to remove all indicators. Hold on. I'm going to take my CRB here. Check it out. And remove all indicators. Remove all drawings. Then I'll just overlay. If you zoom out from these things, hold on. New price scale. Okay, here it is. Remove that one. So if I zoom out, I put the CRB with oil, sure, they track. But this is nothing. A few months of divergence. It happened a whole bunch of places, right? They're not lockstep, these things, right? If I put the correlation coefficient, you look here, it was even trying to break out. That's pretty cool.
You also have to bear in mind that CRB contains a lot of things that are doing very well at the moment,
yes.
like gold and silver, for example. It includes coffee. We know what's happened to coffee and cocoa as well. So some of these commodities that have been exploding upwards are, and I think there's another one there, lean hogs, is it? I think cattle and lean hogs have been going gangbusters as well. So there's a lot of stuff in the CRB index that is doing incredibly well, and in fact it's all-time highs. So that's driving the CRB index higher. Oil in isolation is not, and it doesn't have to necessarily follow the path of those. That's right. Those commodities.
Look, the correlation, seriously, but the correlation usually it's high, but there's periods where the correlation. Well, man, this is historical. Look at that, the correlation there. These rare events.
Low, isn't it? Yeah.
Yeah, it's very low. So so there will be some type of reconnect eventually. Statistically, something's gonna happen. So it's who's going to win. Right?
So either oil goes blasting up, or the rest of the commodity index comes crashing down.
Yes. So imagine that. Okay, the correlate exactly. That's exactly what's happening. What Kevin told you. You can't front run this stuff. You got to be careful here, because if you think, like, let's say Doge is going to start cutting unemployment and whatever, they're reducing the public debt, all that stuff's recessionary, right? So is oil? The market's not stupid. You gotta really listen to this stuff, right? If oil's not blasting upwards, it's telling you that something could be happening. You gotta we're a few months from this resolving. Like oil has to go somewhere. It's like it's close to the apex. I don't like something's gonna.
There are a lot of similarities with the 1970s, which bear consideration, because just look at the 10-year bond yields. They've risen to 5%, and they're still hovering somewhere near 4.5%. And inflation hasn't gone away in the way that a lot of people perhaps expected that it would. So inflation is just kind of hanging there, not going away. In the early 1970s, that was very much the situation, and oil was, of course, in the early 70s about to go completely bonkers. So that breakout of the 10-year yield that we've just seen a couple of years back is very analogous to what happened during the 1960s with the 10-year yield when it broke out through a very long period of downtrend. So there are quite a lot of similarities and parallels to the 1970s. But what Pat just said there, really just wait for the oil chart to either break support or break through resistance, because there's actually not much distance between the resistance and the support level on the oil chart at the moment. So it doesn't have to move up very far or down very far before we're going to get our answer. So why front run that? We know commodities are going great, but we don't, there's a little bit of a question mark over, is that going to continue? I mean, gold is, as I said, gold is in the CRB index. Gold has had a very strong run, and there is an argument to suggest that if we do head into a recession, clearly we're likely to see some pullbacks in these things. That could well be the CRE event. It could well be the point at which stock markets start tumbling, and we do get a significant pullback in precious metals, maybe, I don't know, 20% or so, 15%. And at that point, with a rapidly falling stock market, that's where you're going to be exposed if you're holding precious metals mining stocks. Precious metals mining stocks are going to be much more susceptible to a larger pullback than gold. And that's, if you look historically at these past events, oftentimes gold and silver don't really pull back particularly severely during this rollover of the stock market. But there's certainly times there where the gold and silver miners do fall quite a lot initially, at least. So
what's going on there with the mining stocks? Because you have a nominally high gold price as well as a silver price, and the oil price appears to be subdued. So the delta between the input costs and the actual price of the metal is getting wider and wider. But these mining stocks are,
and that was a problem for the miners in the 1970s. If you study this, in the 1970s, the miners did not outperform gold in that massive bull run that gold had. Its biggest bull run ever in history. The miners did not outperform gold. In fact, the miners did particularly poorly, and I suppose the fundamental reason for that, not that I spend a lot of time thinking about fundamentals, is the oil costs, and not just oil but labor as well. So rapidly rising labor costs, labor disputes, strikes, high oil prices. That's an absolute disaster for miners. So that is no doubt why the miners massively underperformed gold during the 1970s bull run. That wasn't quite the case in the 2000s bull run. In that bull market for gold, the miners just about kept up with gold. So in the 12-year period from 2000 to 2012, that entire bull run, gold and the mining indices like GDX performed roughly equally. There were points in time where the GDX and the miners massively outperformed gold, but that didn't persist. So that by the time we got to the end of the precious bull market and precious metal bull market and gold reached its peak, the miners had given back all of that advantage. Now, I know there are individual exceptions, and individual mining stocks will outperform all of those and do incredibly well, and that's our job to spot those. But if you're talking about the index, GDX, GDXJ, SIL, SILJ, the HUI, those sort of indices, over the full period of the precious metals bull markets so far, that in the big major bull markets so far, they have failed to overall outperform gold, which is another reason why, if you're a nervous investor and you don't really know what you're doing, it's far better just to stick your money in gold and then wait until you get the evidence that the gold bull market is nearing its end. Because trying to time the getting in and getting out with the miners is, even for people who have a little bit of an idea what they're doing, which I would like to think I do, it's still very, very difficult. It's not an easy game at all. Your stop loss gets hit, you're halfway to your profit limit, and suddenly there's a pullback. stop losses hit, and the gold forecast doesn't change. You're still motoring on towards $10,000 gold, but you get some sort of turbulence along the way, and all of your trades get knocked out. So, it's a miners are inherently frustrating. They're inherently fraught with risk. So for that reason, I personally wouldn't put a huge portion of my NAV into them. But as Andy just said, from the value point of view at the moment, there's a big discrepancy between the price of gold and where miners are sitting at the moment, and that applies to right the way across the mining sector, whether it's gold miners, silver miners. It's a generalized condition at the moment in the mining sector. And if oil does start to trend rapidly upwards, I wouldn't touch miners with a 10-foot pole. If it does start to look like we're replicating the 1970s, forget miners. Just go for the metal, because we know what happened to the miners in the 1970s. They did not outperform gold. You would be having to pick one or two very isolated diamonds amongst all of the rest of the crap that's in there to find the ones that are really going to outperform gold. And when gold is going to do so well. So if oil breaks out, I would be very nervous about going long the miners for any period of time. And if oil starts going aggressively upwards, then that does start to raise questions over what the miners are likely to do.
Yeah, it kind of makes sense, because if you have all this upside in the metals themselves, why do you need to go further out the risk curve and get a little bit more torque to your upside? Yeah, you could probably snag an extra 2x multiplier or a 3x multiplier if you pick the right mining stock. But at the end of the day, it's also a lot. It could be a lottery ticket, but by that same token, it could also be a landmine. So very good points here, Kevin. Anything else you guys want to talk about before we wrap up? I think we've covered all the key points.
Just a quick honourable mention for uranium. The uranium miners have not been outperforming gold for 3 years. Okay, so anyone who's in the uranium sector, if you look at the ratio chart there, it's been 3 years, 2022, 2020, late 2022, 2020, early 2023, I think. Anyway, best part of 3 years, the uranium miners have not been outperforming gold. They're stuck in a sideways to slightly downtrending pattern versus gold. So another example of exiting when the target's reached, waiting for the pattern to play out, and then buy the breakout. Now, you could argue that uranium miners are undervalued or whatever, but it's been a very there's a lot of opportunity cost there in being involved in the uranium miners, whilst, you could have had your money sitting in gold and massively outperforming. So just, use those ratio charts. And also one other thing to mention, of course, anybody who's into crypto watching this, the capital rotation event is not going to be a friend of crypto either.
How dare you? How dare you say that?
But we may have enough time. We may have enough time for crypto and Bitcoin to reach those targets first. But of course, they're hesitating at the moment as well, just like oil.
Do you think Fartcoin is going to head into a bear market?
The less said about Fartcoin, Trump coin, and Melania meme coins, the better, as far as I'm concerned. But hey, go for it. That's
anti-American. You're not allowed to say that anymore.
If that is your thing, then
we're going to slap on an extra tariff.
Okay. All right, guys, that was a regular podcast. Now we're going to talk about conspiracy theories. That's how it's done, guys.
Yeah, take it away.
Sorry, Danny, we might have just got your show cancelled.
Can I show an oil chart?
Go ahead.
Real quick. I know you were talking energy. I'm an oil guy, so I'll just share a chart here real quick.
Yeah, sure.
Go through all these tabs here. Hopefully it shows up.
Yep,
yeah, so just to share my opinion on what I think oil is. I think oil, it consolidates, has an advanced phase, consolidates. It consolidates in the 3-wave consolidation patterns, 1, 2, 3, moves on up. And we've gone through the consolidation phase, the 1, 2, 3 pattern there that you guys can see repeating over and over. Yeah. So I think what's coming is the bottom was 2020, which was here, of the bull market. This is the last fractal of the last bull market from 2000 to 2008. And I think that it's basically going to do something on the lines of that. It's just going to repeat and go up again. Now, could there be a recession before this occurs? Have we gone through the recession already? That's really, really difficult to know. That's where I'm like, I just don't know. In the short term, they're selling bonds on the short end like mad. It could be distorting the curve for all I know. And that's where I'm kind of like, I don't know on that, the yield curve. And if it's going to reinvert, it's difficult to say. But I think this is what will eventually occur. And I've got these horizontal lines here. So we basically trade between these horizontal lines, like this guy here. We established a new high, broke through it, established a new level. I think we're going to break through it and establish a new level up above it at some point. So this is kind of the bigger picture, longer term view that I think is going to occur. And during these time frames, every single one of these advanced phases, gold's been a leader and has really ripped. And I think icing on the cake here is the interest rates going up too. You were talking about the precious metals and the miners. I'll do a quick thing on that too. I think that money hasn't rotated into it because the NASDAQ and crypto is still working. So money's just continuing to chase. It's a bunch of FOMO people, retail investors. They just continue to move over there. You can see it on Twitter. These people are diehard crypto nuts, I will call it. Maybe not nuts, but they're just diehard crypto people. And they will attack you if you say anything negative about their precious, I don't know, precious zeros and ones that they're hodling. Is what I'll say. They're not coins, they're just zeros and ones. But I think this is an indicator of where we're located in the bull market of all this stuff. Intangible assets is a function of financial assets. Remember when I started off that all the money is pushed into financial assets because of the declining interest rate environment over the past 40 years? This is an outcome of that. So crypto is an outcome. The intangible asset is an outcome of people jamming their money into the intangible asset classes or financial asset classes. Interest rates broke up out of that 40-year downtrend, and I think it's all going to change because of that. It just hasn't changed yet. So I think the discrepancy in the gold miners versus gold, I think it's an opportunity. It hasn't moved yet, but I think if interest rates continue to move up, we very well could see capital rotate out of crypto and out of the NASDAQ and all that stuff. And then it will be a glorious time for those that are positioned in hard assets, commodities, and the equities of those areas.
There's one thing that I just wanted to say to balance the, I'm aware that people will be watching this who are fans of particularly Bitcoin, but perhaps other cryptocurrencies as well. There's a question mark during the capital rotation event. I fully expect cryptocurrencies and Bitcoin to be, for want of a better phrase, crushed. Okay, Bitcoin regularly falls 75, 80% anyway in its bear markets. We know that. And other cryptocurrencies fall between 99 and 100%. Many hundreds, if not thousands, of crypto coins have ceased to exist. So I expect a very, very severe bear market for cryptocurrencies and Bitcoin when the capital rotation event occurs. The one question in my mind is when the recovery comes, when the stock markets have hit their bottom after a year or two, and the SPX has fallen 50%, and perhaps the NASDAQ has fallen, let's say 75%. What will happen to cryptos then? How will Bitcoin? Let's forget about the other cryptos because they're more volatile. Let's just focus on Bitcoin. What will Bitcoin do? How will it react when the stock market starts to recover? Because when the stock market starts to recover, we know gold and silver massively outperform because it takes many, many years for the stock market to get back to where it started. And during that period of time, we've seen what happens in capital rotation events. Gold doubles and then it doubles again and then it doubles again. So we know that gold and silver will massively outperform. Bitcoin, what will it do? Will it only go back up at the same rate as the stock market and take years to get back to where it was? Or will Bitcoin outperform the stock market on the way up? And if it does outperform the stock market on the way up, will it outperform gold and silver as well? And that's one question I've got.
Here's another question too. When we've been talking about this capital rotation event after a potential crash or something of that nature, what if the crash is not nominal? What if it's only in real terms? Is that something on your radar screen?
That's
Meaning that with the
Do you
market,
mean versus gold rather than being in
like
nominal
versus
terms?
gold or versus M2 money supply or versus
Yeah.
CP, something like that?
Well, it's
Could the crash
possible.
not be nominal, but in real terms be a
It
crash?
has to be nominal. It has to.
Yeah. We
I don't
we
want
in
to not
fact
do it,
talked
has
about
to.
this, but it has to happen in nominal value, in nominal terms. Because
Right.
if it doesn't happen nominally, sorry, Pat, you go.
No, that's fine. You go ahead. We you know the speech.
Well, Pat and I have these brainstorming sessions all the time to try and reason all of this stuff out, and really, it does have to be in nominal terms, because if you don't get the needle shifting in nominal terms, then you're not rotating anything from anywhere to anywhere. Now, we're not talking about money going directly from NASDAQ into gold or from the S&P into gold. It's not quite as literal as that, but you have to have a process taking place where it's big enough to shift the S&P and the NASDAQ downwards nominally. It has to move the needle at least 10 or 15% in the stock markets to cause the gold to SPX ratio to break upwards. Otherwise, stock markets will continue to trend gradually upwards, and gold will continue to go upwards. The ratio will go nowhere, and you have no capital rotation event. The term rotation means that ratio chart has to turn and move back down. The S&P has to break down versus gold. So that in order to get that rotation and to move that chart, you have to have the S&P and the other stock market indices moving down by a significant amount in nominal terms.
Yeah, because look, the fund manager doesn't price SPX and gold. He might have maybe some algos, some metrics and stuff to figure it out, but you need something priced in dollar amounts to instigate this fear, this thing that's going to rotate, that they have to print the money to save the recession. It all starts with the SPX starting to unwind. It's a nothing burger until then. You could do ratios. Oh, that one's outperforming, fine. But the true mind-boggling, when people start mentioning 10 baggers and putting these crazy logarithmic move targets, they happen after the CRE. Andy's chart of oil, those key moments where it got re-rated like higher there, did those expansionary moves. Those are all CREs. Late 1960s, 1970, the late 90s, 2000, and whatever's going to happen now. All those three events are capital rotation events. With the stock market plunging, they have to print the money, and then oil has to reprice in that craziness, right? That destruction of purchasing power. Oil has to reprice it because oil is the destruction of purchasing power. The higher the energy cost, the less your dollar's worth money. They go hand in hand. The oil chart is the fluctuations of the CPI compounded, the fluctuations of the inflation rate compounded over decades, right? Because the inflation rate, it stacks eventually in the permanent purchasing power destruction. And that's the oil chart. That's all it is, right? I could overlay the CPI, the rate of the inflation rate over the oil chart, and you'll see the oscillations of the oil chart is that, but because it compounds it stacks nominally, right? Keeps going up and up because your fiat's going down. Does that make sense with my fingers? I hope, guys, you followed how I did that there.
Clearly.
1,000 words, Pat.
So when you guys said they need to print money or whatever, that money can also be created through the real estate market, through loans, monetary bank lending.
Yes.
That's what the 70s was driven from, the
Yes.
40s, 50s, and 60s and 70s.
Yeah.
We're also in the middle of the demographic for household formations right now in America. So that's also pushing behind the market. We don't have foreclosures. Like all of those recessions that we were talking about, those are all real estate recessions driven by real estate, all of them almost, outside of 2000. So it was there's a couple in the 70s that were driven by real estate. Real estate fell and bank lending fell, and that's what caused those recessions. So
Andy, do you agree with the North Star boys about a nominal crash, or does it have to be nominal, or could it be in real terms?
I don't know if it has to crash. I don't know with 100% certainty there. I think what could occur is money could rotate without a crash necessarily, because people have to sell this stupid crap that they own, like crypto, and have to spend it on something that they absolutely need, like getting to work or energy and food. So I think things could naturally rotate, but generally you do get a recession because the things that people like, you have a shift in the economy between, it's like there's a misallocation of capital. So technology needs to get hit, and that money has to rotate over into, oil and food and whatever else that we need more production of. So I don't know if it can do that without having recession. I don't know. It's a tough one.
I
Maybe
agree.
they might be right. I don't know.
But I think look at this, guys. This is the total public debt. This is the government, debt. Look at the explosion. Of course, the debt's always been going up, right? I don't care that it's 35 trillion. It could be a billion, gazillion Googles. I don't care. It's the rate of change that creates these market reactions. Here at the bottom, I have this distance from the 6-quarter moving average. So it's the debt keeps going up and up, but it's how fast is it going up? And look at the capital rotation event here, the late 60s. The rate of the distance from moving average, the explosion in the change in the total public debt, the money, the government that they have to borrow to pay for the programs, to save, to bail out the banks, to bail out the real estate, whoever, whatever. That's, look, higher lows, higher highs. That was the oil run, the silver run, the gold run, right? And even if here the debt keeps going up and up and up, look, it's not able to distance itself from its moving average as fast. And look at that. That was the crazy 1980s to 2000 run in U.S. stocks. And look at that. Even the recessions within that downtrend were explosions in total public debt. Here, CRE. Here's a 2000 CRE. Look at this beautiful breakout. Recession, the market always drops. So it happened again on that watch. Here, recession, market drops. The explosion in debt. We had here the one in the 2020, but here's probably going to be the next one. The next time we have a recession, the government has to go back into debt. So whatever Doge is doing or whatever, maybe that's just the chicken and the egg, create that tsunami of recession, right? Like debt's going away. It's the market says, you're breaking me. So people have to sell their SPX to buy real stuff that they need. And then they re-explode the debt. And that's when Mr. Commodity there goes bonkers there and starts showing his NAV, his net asset value on Twitter there. That's when, those guys, we start doing that, right? So, but that hasn't happened yet, guys. It's like something has to instigate all this, and we're on the cusp of it. We could be on the cusp for the next 6 months, a year. I don't know. That chart, that's where the charts come in handy, guys. You just don't, there's zero opportunity cost with charts, right? You won't catch a bottom, but at least you won't stay in the sideways huddle, right?
Okay, I'm going to ask you the $64,000 question. If you had a gun to your head and you had to give a time frame in terms of when this capital rotation event happens, I'm not going to hold you guys to this. Just if you had to pick a time frame as to when it occurs, when do you think it occurs? Andy, I'll start off with you, and we'll go finish things off with this question.
Well, I think it's already in motion. It's already started. I don't think it's apparent to everyone. So I think the whole thing started in 2020 when they printed all that money and it pushed us and interest rates broke out. So I think it's in motion. It's already started. The cycle's already started. So I'm in the camp that things are it's like in motion. Now the confirmation of it comes later when everybody kind of like recognizes it, sees it. So I think it's already occurring, but that's me. I think it started in 2020 and that was our ultimate bottom with interest rates, and everything has progressed forward and we're in the cycle. So think of it as we've done the first wave and we've got a wave 2 pullback in the capital rotation kind of event cycle. So that's what I think.
Yeah. Gotcha. Patrick, what do you think?
Well, yeah, I don't think you could be in it until a true capital rotation. Like if we'd be really in the process, like you'd have silver outperforming gold, and that's just that's not happening yet. So because I need the markets to go down. So it's all a question about timing the markets. I have the SPX chart memorized. There's a rising trend line on the monthly chart, still above its 12-month moving average. So from a mathematical aspect, I don't know, it probably needs at least a few months just to start maybe closing below that rising trend line and then properly starting to maybe stay below it. So it can't, 6 months, maybe we start, we start getting some SPX closes below its rising trend line, 3 to 6 months, and after that, maybe later this year, it really starts unraveling. Yeah, it could take a little time there for that big ship to turn over there.
Gotcha. And Kevin, what do
But
you
then you
think?
put a gun to my head. I don't like putting price projections.
Well, we started off talking about guns off camera, so we
Yeah. Because it's all about the
Go full
breakout, guys.
circle.
People have to remember this. People put timelines. Hey, Patrick, you said 2025 gold, silver would be
No,
whatever.
I'm not going to hold you to it. I'm just
But-
curious. Like
yeah,
if you
but I'll
had to
explain-
choose, yeah.
Yes, but I'll have to explain because these roadmaps, they stretch in time until the line, the most meaningful line is breached. That's what the chart trader does. The better the chart trader, the better he's able to tell you this line is the most meaningful one. There's a whole bunch of lines that are they're breakouts, but the most meaningful one, which one is it? I identify that. We identify that. And my crazy target, it scales in time until, oh, I'm above, bam. That's pay dirt for me. That's the greatest moves in the shortest amount of time. That's it. Whatever happens under, I don't care. It's like, yeah, it went up off a bottom 100%. I don't. For me, I'm going for the 800% in the shortest amount of time. So I gave you my target, but there's no breakdown yet in SPX, so it's kind of slightly meaningless. It's just a fun guess, right?
Yeah.
So don't hold me to it.
No, we won't. We'll see. We'll only hold you to it if you get it right.
True. Of course, I want the credits. Yeah, of course, I called the top guys. Come on, guys.
Kevin, what do you think?
I'd say 6 to 9 months, something like that. For me, it's a capital rotation process that comes about through a series of evidence. And as Andy said, the evidence started coming in some time ago that the process was beginning. The event confirmation for me, anyway, comes when SPX has fallen something around 15 to 20% and pushed the gold to SPX ratio above 0.5. So the charts suggest that could happen anytime in the next few months. We're not talking years here, we're talking months. And it looks logical from the charts that it could be late this year. It could extend into the early part of next year, but it looks as though the confirmation is likely to come towards the end of this year. But it literally is a case of seeing SPX fall nominally something around 15 to 20%. We have a target on our charts for the gold to SPX ratio and what the current SPX needs to fall to. I mean, it's 50% of the gold value. If gold is $3,000, then you need SPX to fall to 6,000. Okay, if gold is 2,800, then SPX needs to fall to 5,600. So, as the gold price moves up and down, you can work it out simply in your head, just double the gold price. And if the SPX falls to that value, that's your confirmation. And I would say late this year is the most likely time.
Oh, goodness. Imagine if it breaks down like next month.
It can happen. It's a rocket on a launch pad, and the fuse is pretty much lit. It's just a case of how long's the fuse, but it's ready to go.
Yeah, fun guest. That's all. Just wanted to see where your headspace was at. Well, guys, thank you so much for coming on. Great interview as always. Let's go around the table, and if you want to plug anything, go ahead. Andy, I know you've got your YouTube channel, Finding Value Finance. Anything else you want to plug?
No, you can find me on YouTube, and you can find me on the website that I've got. So yeah, that's all I've got.
What's your website?
So finding-value.com.
All right. Patrick, Kevin, where can people find you guys? Patrick, you can go first.
NorthstarBadCharts.com, guys. We get all the juicy details there. Else Twitter, man. There's always great stuff happening on Twitter. BadCharts1 on Twitter.
All right,
and
Kevin.
Yeah, same here. It's at Northstar Charts on Twitter, but NorthstarBadCharts.com. And you can find me, Kevin Wadsworth, on LinkedIn as well if you're really that geeky about it.
Awesome. We'll have the links to everyone's socials down below, so be sure to give everyone a follow and check out the websites. So with all that said, thank you guys for watching, and give us a like and subscribe to the channel so you don't miss an episode. If you agreed with what any of the participants had to say, right, go Andy go, right, go Kevin go, or right, go Patrick go. I want to see who won. Drop me who you think won in the, well, it wasn't a debate, it was just a fun discussion.
The teddy bear one, there you go. He's been sitting there taking it all in.
You know who won, Andy? Danny? The viewers won, hopefully.
Oh my God, that hurt me.
Very corny.
All right, guys. Well, I hope you enjoyed the show, the interview. Drop me your thoughts. Really interested to get your thoughts. And check us out on Substack at capitalcosm.substack.com, where you can get early access and ad-free versions of all of my videos and uncensored versions for the videos that warrant it. And yeah, thanks for watching. Catch you later. Bye.